Hey, Sophia, have you ever felt like you're playing a high-stakes board game, but with real houses and confusing paperwork?
Oh, I know exactly what you mean, Alex. It's that feeling of looking at a beautiful garden and then realizing there's a whole mountain of financial terms to climb first.
Right? Like you want the keys to your dream home, but first you have to understand this massive, multi-layered financial puzzle.
Exactly. And today, we're going to give everyone the map to solve that puzzle, one piece at a time, so you can feel confident when you walk into that bank. Welcome back to Daily Seed English Podcast, the place where we help your English skills grow from a tiny seed into a strong, blooming tree. I'm Sophia.
And I'm Alex. We're so glad you're here with us today. Whether you're listening while commuting, doing chores, or just having a quiet coffee, we're here to help you branch out into new vocabulary.
That's right. Today, we're looking at something that feels like a massive growth step for many people, buying a home and navigating the complex world of bank loans.
Yes, we're diving deep into the world of banks, loans, and all those tricky phrases you need when you're ready to say, I'm buying a house. So, Sophia, I was looking at this beautiful cottage online yesterday, totally just dreaming, and I saw the word mortgage. I know it has to do with money, but it sounds so formal and a bit scary.
It does sound a bit heavy, doesn't it? But really, a mortgage is just a specific type of loan that you use to buy property, like a house, a condo, or even a piece of land.
Okay, let me make sure I have this straight. A loan is the general term for borrowing money for anything, like a car or a vacation, and a mortgage is specifically for the home.
Exactly. When the bank helps you buy a house, the house itself acts as security for that money. That legal agreement is the mortgage.
Got it. And in this situation, I would be the borrower, right? Because I'm the one taking the money and promising to pay it back.
You've got it. You are the borrower, and the bank or the financial institution is the lender. They lend the funds and you borrow them under specific conditions.
Okay, so I go to the lender and ask for a mortgage, but I don't just get the whole $300,000 for free, right? I need to have some of my own money saved up first.
That's a very important point, Alex. This is where the down payment comes in. Usually, the lender wants you to pay a certain percentage of the house's total price yourself, right at the start.
Like a big admission fee to show I'm invested?
Precisely. For example, if you're buying a house for $400,000, you might make a 20% down payment, which would be $80,000 of your own savings.
Wow, that's a lot of savings to have ready. Is that the same as a deposit? I've heard people say they put down a deposit on a house.
They are related but used slightly differently in the process. A deposit, often called earnest money, is what you pay very early on, sometimes the same day you make an offer, to show the seller you're serious about buying that specific house. It locks in your interest.
Oh, okay. So the deposit is the I'm serious money that goes to the seller, and the down payment is the here is my share of the total price money that goes toward the purchase at the very end.
Exactly. And because the lender is giving you such a large amount of money for a very long time, sometimes 30 years, they charge you for the service. Do you know what that's called?
Oh, I know this one. The interest rate, right? It's like the rent I pay for using the bank's money.
Spot on. The interest rate determines how much extra you pay back every single month on top of what you borrowed. A lower rate is always better for the borrower because it saves you thousands of dollars over time.
And I've heard there are different ways the bank calculates this monthly cost. One is a fixed rate mortgage, which sounds pretty stable.
Yes, many people love a fixed rate mortgage for exactly that reason. It means your interest rate stays exactly the same for the entire life of the loan. Whether it's a 15-year or a 30-year term, your monthly payment for the house doesn't change.
That sounds much safer for planning a budget. You know exactly what you're paying every single month for 30 years. No surprises if the economy goes crazy.
Precisely. It's all about peace of mind and stability. But as we'll explore, there are other types that might start out cheaper but can be a bit more unpredictable later on.
That sounds like a bit of a gamble. Let's take a quick breath before we look at how someone actually starts the whole application journey. I mean, do I just walk in and ask for a check, or is there a mountain of paperwork?
Oh, Alex, it's definitely a bit of a mountain. It requires patience and a lot of organization, but we'll climb it together, step by step, in the next part of our deep dive. So, Alex, remember how we talked about fixed rates? There's another kind of loan called an adjustable rate mortgage, or ARM.
This sounds like the unpredictable one you just mentioned. Why would someone choose that?
Well, an adjustable rate mortgage, or ARM, often starts with a lower interest rate for a set number of years, like 5 or 7 years, compared to a fixed rate. But after that initial period, the rate adjusts according to the market, so your payments could go up or even go down later on.
I see. So an ARM might be good if I only plan to live in the house for a few years and then sell it before the rate changes.
That's exactly how some people use it. It's a strategic move. But no matter what type of mortgage you choose, your monthly payment always has two main core parts. There's the interest we talked about, and then there's the principal.
Principal? I always think of the principal in charge of a school when I hear that word.
Haha, same spelling, but in the world of finance, it means the actual original amount of money you borrowed. So each month, you're paying some interest to the bank for the service, but you're also paying back a portion of the principal to actually own more of your home.
Oh, okay. So as I pay down the principal, the total debt I owe the bank gets smaller and smaller until eventually it's all gone and I own the house completely.
You've got it. Now, to get to that wonderful point, you have to actually apply for a loan. But before you even go out and find your dream house, most experts suggest getting pre approval.
Pre-approval? Is that like getting a gold star from the bank before you start shopping?
In a way, yes. It's when the bank looks at your finances before you find a house and says, based on what we see, we're willing to give you a mortgage up to this specific amount. It shows sellers that you are a serious and qualified borrower.
That sounds like a huge advantage when you're competing with other buyers. But what do I actually need to do to get that?
Well, you'll have to fill out a formal loan application, of course, and the first thing they're going to scrutinize is your credit score. This is a three-digit number that summarizes how reliably you've handled money and debt in the past.
My credit score. So every credit card I've used and every bill I've paid or missed is reflected in that one number?
Exactly. It's like a financial report card. A high score means the bank sees you as low risk and will offer you better rates. They also calculate your debt to income ratio.
Debt to income ratio. That sounds like a very official math equation.
It is. It's the percentage of your gross monthly income that goes towards paying off your existing debts, like student loans or car payments. If you have too much debt already, your DTI might be too high for a new mortgage.
So the bank wants to be absolutely sure I'm not already stretched too thin and can actually afford the new monthly payment.
Precisely. They're protecting themselves and you. And to prove what you actually earn, you need to provide solid proof of income. This means things like your recent pay stubs, tax returns from the last 2 years, and maybe even letters from your employer.
Oh, I see. So it's not enough to just tell them I have a good job. I need to bring a whole folder of documentation.
Oh, a very thick folder, Alex. Bank statements, identity documents, investment records. It's a lot of paper. Once you hand over all that documentation, the bank starts a process called underwriting.
Underwriting? That sounds like something an artist would do. Does it mean they're signing off on my folder?
It's the final, most intensive check. A person called an underwriter double checks every single detail. They verify your employment, your bank balances, your credit history, and they even order an appraisal to make sure the house is actually worth what you're paying. They want to ensure every part of the deal is safe before giving the final green light.
So, underwriting is like the final high stakes review of my entire financial life?
Maybe that's a bit dramatic, but it is a very thorough investigation. It can take several weeks of waiting, and sometimes they ask for even more documents. But once that hurdle is cleared, you are incredibly close to the finish line.
Wow, so once the underwriting is finished and they're happy, I'm basically ready to go sign the papers and get my keys.
Almost. Once you've crossed the hurdle of underwriting, you finally receive that glorious official loan approval.
That sounds like music to my ears. So at that point, the house is officially mine?
Not quite yet, though you're very close. Before the final meeting, the bank will send you a very important document called a loan estimate. This is a 3-page form that spells out every single detail of what you're paying for.
Okay, so it's like a final detailed receipt or quote for the whole mortgage.
That's a perfect way to put it. It shows your exact monthly payment, your final interest rate, and a breakdown of all the associated fees.
And does it include all those extra costs I've heard about, like closing costs?
Yes, it definitely does. Closing costs are the various fees you pay at the very end to finalize the deal. Things like taxes, title insurance, and fees for the lawyers and the people who processed the paperwork. They can add up quickly, sometimes being 3 to 5% of the house's total value.
Wow, that's a significant amount. So I really need to have two separate pots of money saved, one for the down payment and another for the closing costs.
It's a lot of saving, Alex, but the loan estimate also highlights a very important number, the APR, or annual percentage rate. This is often slightly higher than your interest rate.
Wait, APR? Annual percentage rate? Why is there a second percentage? Why isn't the interest rate enough?
That's a common point of confusion. While the interest rate is just the cost of borrowing the principal, the APR includes the interest plus those closing costs and other fees. It gives you the real total cost of the loan each year.
Ah, I see. So when I'm shopping around, the APR is the most honest number to use when comparing different banks.
Exactly right. It levels the playing field so you can see who truly has the better deal.
And then we have this strange word, amortization. It sounds like something from a chemistry class.
It does sound technical. Amortization is simply the mathematical schedule of how your loan gets paid off over its entire life. At the beginning of your 30-year journey, most of your monthly payment actually goes toward interest, but as time goes on, the balance shifts and more of your money starts going toward the principal.
Okay, so if I choose a longer loan term, like the standard 30 years, my monthly payments are smaller and easier to manage, but I end up paying much more in interest over the long run because it takes so long to pay it off.
You've got the logic perfectly. A shorter loan term, like 15 years, means your monthly payments are much higher and tighter on your budget, but you'll be completely debt-free 15 years sooner and save a fortune in interest.
That makes a lot of sense. It's all a big trade-off between how much you can afford each month and how much you want to pay in the long term.
It really is. And once you settle on a term, there's one more thing you should ask about: prepayment.
Prepayment? Is that like paying some of the bills before I even move in?
Not quite. It's when you decide to pay more than your regular monthly amount later on, maybe because you got a big bonus at work or a pay raise. Some banks actually have a penalty or a fee for prepayment because they lose money when you pay the loan off too fast.
Wait, they punish you for being responsible and paying back your debt early? That seems so unfair.
It can feel that way, so you always want to check your contract for prepayment penalties. Because if you can pay extra without a fee, you build your equity much faster.
Equity. I've heard that word on the news, usually when people are talking about their wealth.
Equity is one of the best parts of homeownership. It's the portion of the house that you really own outright. If your house is worth $500,000 and you still owe the bank $300,000, you have $200,000 in equity.
Oh, so as the house value goes up and my debt goes down, my equity grows. It's like a giant live-in savings account.
Precisely. It's your wealth in the house. And here's a tip. If you have less than 20% equity when you first buy, the bank will usually require you to pay PMI or private mortgage insurance.
PMI. That sounds like another monthly bill I'll have to add to the list.
Is an extra monthly bill. It's insurance that protects the lender in case you can't make your payments, but you are the one who has to pay for it. The good news is that once you pay down enough of your mortgage to reach 20% equity, that PMI fee usually disappears.
And things like property taxes and home insurance. Does the bank just trust me to pay those to the government myself?
Often, to stay safe, the bank sets up an escrow account. You pay them a little bit extra each month as part of your total payment, and they hold that money in the escrow account. When your tax bills or insurance premiums are due, the bank pays them for you.
That actually sounds like a relief. It's one less thing for me to forget about.
It is very convenient, but never forget, Alex, that through this whole 30-year journey, your house stays as the collateral.
Collateral. That sounds like a very serious legal term.
It is a serious concept. It means the house is the bank's guarantee. If a borrower stops making payments and defaults on the loan, the lender has the legal right to take the house back because it was used as collateral.
Right. That's the big responsibility of having a mortgage. You have to manage your payments diligently to protect your home and keep building that equity.
Exactly. It's a long-term commitment, but so rewarding. Now, Alex, let's imagine you're actually standing in the bank today. How would you start this conversation with a loan officer? Okay, Alex, let's imagine I'm the lender sitting behind the desk at the bank. You've just walked in feeling ready. What's the first thing you say?
Well, I'd take a deep breath and start with something clear and professional, like, I'd like to discuss getting a mortgage.
Perfect. A great start. And then you'll want to get a sense of how the market is doing right now.
Right. I'd ask, what are the current mortgage rates? And then follow up with the most important question for my budget. How much can I borrow based on my income?
Those are the essential big picture questions. And if you're curious about different types of loans, like the ARMs or fixed rates we discussed, just say, I need information about home loan options.
And if I'm a little confused about the schedule or how long I'll be paying, I'd ask, can you explain the repayment terms?
That's a very smart question to ask. And don't forget to check for all those extra associated costs. You should ask, what fees are involved in this mortgage?
Oh, and I want to make sure they know I'm a very reliable and safe borrower, so I'll definitely mention, I have a steady job and good credit. Will that help?
It absolutely will. It's like showing them your best financial references. And once you've found the house and everything is approved through underwriting, you'd ask, when can we schedule the closing?
And is it ever okay to negotiate? I mean, can I try to get a better deal? Maybe say, is it possible to get a lower interest rate?
It never hurts to ask, Alex, especially if your credit score is excellent. And once you've had enough information for the day and want to go home and think it over, you can always say, thank you for explaining everything. I'll review the documents.
That sounds like a very solid plan, Sophia. I feel so much more confident about walking into a bank and having these conversations now.
That's exactly why we're here, growing our skills and our confidence, one term at a time. Before we wrap up, we have a question for you, our amazing listeners. Are you thinking about buying a home soon? Or have you already been through this mortgage process in your own country?
We'd love to hear your stories and experiences. It can be a massive life journey, but remember, every new word you learn is a seed that will help you grow.
Don't forget to subscribe to the podcast and share this episode with anyone else who might be dreaming of their own front door one day.
After all, every day is a chance to learn better.
See you in the next one. Bye.
Bye.